Welcome, everyone. On behalf of Cambridge Healthtech Institute's Global Web Symposia and our sponsor, Enrich, I'd like to welcome you to Lessons from the Field, Best Practices in Portfolio Management. My name is Elizabeth Lamb, and I'm the host and moderator for today's event. At this time, I'd like to introduce our presenter for today. He is Dr. Richard Sonnenblick, PhD, CEO of Enrich Consulting. Welcome, Dr. Sonnenblick.
Thank you so much, Elizabeth. I'd like to thank everyone for being here with me today. So as Elizabeth said, I am the CEO of Enrich, and at Enrich, we deploy the Enrich Analytics platform, which helps companies manage their R&D portfolios. In the context of deploying Enrich Analytics, we've also facilitated and assisted with valuation activities and portfolio reviews all over the world. So the information that I'm presenting today has been learned in tandem with our clients managing R&D portfolios, a lot like yours, for over a decade. So I'm proud to say that each year, tens of billions of dollars are shaped, allocated, refined, and tracked with the Enrich Analytics platform. EAP, or Enrich Analytics Platform, is a cloud-based SaaS offering providing solutions for portfolio management, capacity planning, and also sales planning. And it's used worldwide by companies both within life sciences and outside. All these companies have two things in common. They're making R&D high-stakes decisions, and they're doing it in an environment of uncertainty. So, as we see it, EAP is set apart from other offerings because of the advanced analytics, both at the project level, performing Monte Carlo simulation, financial and market calculations, and at the portfolio level, performing optimization, simulation, and scenario planning. And in the past, these capabilities were really only available in Excel. We've tried to bring them to a centralized, always available web-based solution. So that's enough about us. Let me move right along with the agenda today. We're going to start by talking about project metrics. We're going to talk a little about prioritization of projects and how you rank your projects after that. Then we'll talk about risk management specifically as it relates to the portfolio views that are useful, that we've found work well with some of our clients. And then we'll talk about preparing for and facilitating portfolio reviews themselves. At the end, we'll have a little bit of time for questions. So I wanted to start by just taking a step back and asking, what's the purpose of valuation here? Why would we value the projects in our portfolio? Well, I think initially we want to understand, is a project worth doing? Does it have attractiveness? Is it desirable? And then second, we want to provide a basis for comparison with other projects in our portfolio. And then third, and probably most importantly, we want to have good conversations. We want to build consensus around the risks and opportunities, and also how the project could be undertaken to best effect and how we actually do that with our hard-earned R&D investment dollars. So if this is the purpose of valuation, it's important to say that the purpose of valuation is not just to get to a number. That number is going to be helpful, whether it's an NPV or a peak revenue or some other metric of merit, but it's really just a prelude to having effective conversations around each of the assets and then in turn around the portfolio as a whole. So a couple of important considerations before we go further. The benefits of a quantitative model like this, to underscore that, are providing a focal point for those conversations and then ensuring comparability so that when you look at two projects side by side, you have a comparable apples-to-apples basis for thinking about those two projects at the same time and understanding the trade-off between costs and benefits for each. In our history, in our experience, we've seen most companies want to start with too detailed a project valuation model. And there are a couple of reasons for this. One is we're simply creative beings, and it's easy for us to understand that there are many, many things we should be taking into account as we build up our asset valuations. And it's easy to build the models to contain those than it is to collect all of the data that would support that complexity. And it's also easier to build the model than it is to explain it to executives. And so there's a failure mode where you can spend a lot of time building the model, not thinking about the implications for, can we collect data to support this framework? And can we explain this entire framework to our middle managers, our therapeutic area heads, and our decision makers at the top levels of the company? It's important to try to remember, if you can, that you can always add more detail later. It's not critical to add that detail up front. And in fact, one litmus test we've used quite often is, will the additional detail that you're considering adding lead to a better decision in the time available? And in the time available is critical because it may lead to a better decision, but if it takes too long, the trade-off may not be worth it. So I'd like to now go through a piece where we talk about some of the different metrics that can be used for asset valuation. And we start with a series of metrics from the very simplest, addressable market size, moving to essentially an estimate of revenue by creating a product from addressable market size, market share, lifetime, and price. And then from that set of metrics, we can look at revenue-based metrics such as peak revenue, cumulative revenue, 5-year revenue, even a present value of revenues. And from there, we can add the cash flow-based metrics, and then several metrics in addition to NPV that also rely on cash flow. So we often get asked, what's the right metric for portfolio management? And the answer is, it really depends. The factors that we see hinge are strategic goals. What are the specific goals you have for the company in each of your therapeutic areas, short-term versus long-term, in each of the regions based on the technology platforms that you've created? And the metrics need to speak to those. What's the current project phase for each of your assets? Those that are early stage probably don't require a very sophisticated treatment. What's the duration of each project? Are these long-term, high-stakes investments, or are they short-term, relatively low-budget requirements, in which case you don't want to over-model because there's not a lot of money on the line? What's the current period budget request, and is it an obvious we'll do this, or is it a question because there's a lot of money on the line in this next budget? And then the total budget request, the complexity of the technologies involved and the risk, therefore, that exists, and market uncertainties in terms of whether you think there's risk on the market side. And then finally, this is probably most important, the sophistication of the decision-making culture, the decision makers, and then the data available. So pushing very sophisticated methods and metrics on a set of decision makers that are not used to using those probably won't end well. Think about the level of appetite that those executives have for sophisticated metrics. As you consider your metrics, keep in mind that those metrics won't be worth anything unless you ensure comparability across the valuations that you perform. So those valuations have to use a common time horizon, common discount rates. They should all have the same type of cost accounting, be it loaded or non-loaded. The currencies should be similar, or there should be conversion factors between them. And cannibalization, if it's considered, should be considered uniformly across all of these projects. The same for market sizes or epi data, where it's the same, should be applied uniformly across your projects in the same disease area. And staff rates and costs for staff should be the same, to say nothing of all of the other pieces of revenue buildup and sales and marketing costs and so forth. So let's talk for a moment about that first set of metrics, what we call the revenue story. These are used to build up, in a simple way, an estimate of revenue over time. And what I'd like to show you here is a dashboard that is both an input dashboard and an output dashboard that allows you to focus on different components of the revenue story so that you can tell the whole revenue story at once and not just provide a number, such as the cumulative revenue. let's look in the top right corner first. Here we have the market segments defined for this particular product and the size of each of those segments and the share that those segments will receive after all other filters have been applied. Here you have the next set of filters that show the number of folks in a percentage basis who would be acceptable for surgery, those who meet the income screen, and those who meet the health screen. And you see how these are applied to the specific segments up here. And I neglected to say this is an imaginary product analysis for an implant for Google search that you would have added to your own cranium. And so now we have a simple sentence, but it's actually a forecast on customer purchasing and repeat customer purchasing and how long the time horizon is for this. And then a simple estimate of the sales curve, rather than entering these data 1 year, 1 month, or 1 quarter at a time, just doing this in a very simple basis. And so the result is, first, you have a simple patient flow model like this that shows you your total market size, the segments that you've defined, and the filters as they apply to get your thin sliver of actual customers who are purchasing. And then you have your units over time and your revenue over time, and you can look at that cumulative revenue here. And so this dashboard brings all of this together to show it to you in one fell swoop, and this is useful for both product teams and for management as they review a particular business case. Now let's move ahead to net present value. So net present value is much maligned and often used. What's so good about it? Well, first, it does take total costs and benefits into account. It also distills the P&L and its many line items into a single number. And it gives a sense of, across the portfolio, the overall winners and losers. And finally, it takes the time value of money into account as well, knowing that what we have today is more valuable than what we might have 5 years from now. It can be risk-adjusted quite easily, and we'll talk about that in a moment, to account for the possibility of failure. And of course, it's familiar to many people. And familiarity does breed contempt, but it's also something that everyone understands or can begin to understand if it's explained to them in the context of the asset. So now what's the flip side, the shadow of NPV? NPV does hide the total cost of each project. You could have 2 projects with the same NPV, one with a much larger expense or capital load than the other, offset by a benefit, so you can't see that. So one solution here, as we'll talk about shortly, is to use a productivity metric where you divide the NPV by the remaining costs for that project. Also, we totally agree that NPV doesn't tell the whole story. It's important to employ other value metrics and think about portfolio balance as well. And the NPV is wrong. It's a point estimate, and even if it's a range, it's likely to be wrong. So it's important to keep a healthy sense of skepticism around false precision and the idea that this number is exact. And then also, most importantly, it's not appropriate for your early stage compounds or for pure research ideas where the product segment or the customer segment or the pricing hasn't been identified. So let's look at risk-adjusted net present value for a moment. We'll start with a phase 1 cost, and we understand that this phase may end in success or failure, and if it ends in failure, we abandon further development for this molecule or for this initiative. If it succeeds, we'll move to phase 2 and incur the phase 2 cost. And if that succeeds, in this shortened example, we'll move straight into the benefits that come from our revenue story. So we can think about this formulaically as incurring the phase 1 costs, incurring the phase 2 costs with a probability of phase 1 success, and then incurring the benefits with a further probability of phase 2 success. And you can then easily extend this to multiple phases, as many phases as you'd like. And so one of the benefits of this risk-adjusted net present value is it doesn't require Monte Carlo simulation, as long as you don't have underlying uncertainties in your benefits that you want to add in. And then the benefit stream B and the cost C1 and C2 can represent the present value of a series of costs and benefits over time, so you have a true net present value that's been risk adjusted here. So, of course, there are other metrics as well, and we can think about those here. First, looking at some simpler metrics such as cumulated sales, discounted sum of sales, peak sales, moving to net present value. Then thinking about maybe an annuity corresponding to the NPV if you're interested in comparing this to other less risky investments. And then also looking at internal rate of return and some of the derivatives of internal rate of return, where internal rate of return is the discount rate, such that the cash flows equate to an NPV of 0. You can think also about return ratios in different ways, where you have the NPV of everything after launch over the NPV of everything before launch, or the NPV of everything after the first year with positive cash flow, or the entire lifetime, a simple risk-adjusted return ratio. I think these pictures from Toke, Ward Peterson at Roche actually make this very clear. And then finally, a series of other cash flow-based measures such as the first year with positive cash flow, break-even year, most money at risk, and then a freshness rating, looking at the percentage of revenue from new products, say in year 3 or year 5, after a given set of launches have occurred. So we often get asked, should you capture uncertainty? And we know, for example, that every point estimate is in fact wrong, but that doesn't mean that we should be adding uncertainty to every single estimate or input that exists in your valuation model. What we often see then is what we call pajama valuation, where there are so many inputs that the model is just filled out the night before the portfolio review or the night before it's due, when someone's sitting at 11 p.m. in front of their laptop in their pajamas. There's an important prerequisite to capturing uncertainty, that is that the culture that exists in the company encourages management and discussion and embracing of uncertainty rather than ignoring uncertainty. Many cultures in companies look at precision as a core competency, and they feel that they need to be right every time. Drug development is not one of the areas where that actually works very effectively. Also, we're asked, what are the important drivers of uncertainty? What are the key inputs that should be parameterized with a series of ranges or other uncertain inputs? We see success by phase and maybe approval by region as leading that chart, and followed quickly by reimbursement and share. And if you're a price taker in a market, because you're moving quickly to a competitive scope within a given disease area, then that price is uncertain as well. So capturing this uncertainty, we feel that only biostatisticians and petroleum engineers really understand probability distributions in the way that statisticians think about them. So the idea of using normals, log normals, betas, gamma functions, etc., that's not really appropriate. It's better to think first about discrete events, so the probability of something occurring, a 30% chance of moving into phase 3 or a 20% chance of achieving a target product profile. And then continuous events represent something that could take on a range of values. And for those, we usually ask the experts in the clinic or on the project team for a low, a medium, and a high estimate. And then we can either translate those to a series of fractiles, usually a 10%, a 50%, and a 90% fractile. So you've described an 80% confidence interval. And then you can interpolate that to one of the distributions that the biostatisticians know and love. Or you can simply assign probabilities to those low, medium, and high estimates. Of course, those probabilities have to add to 100%. So one key here as well is to always use sensitivity analysis and see for the inputs that have been provided and the ranges that have been provided, do they have an impact on the overall NPV or other metric of merit of this asset? And if they don't, you might be wise to think next round not to include quite as many uncertainties in your inputs. All right, moving along to prioritization. So prioritization is simply sorting by desirability. You have a series of products, projects, initiatives, and you want to be able to sort them to prioritize your spending. So you can very simply do this based on one or more metrics that look at value, such as a risk-adjusted NPV or expected peak revenue. Or you can look at productivity, which takes into account the cost of each of these investments, specifically the total cost to launch and also the cost in the current budget period. And look at the bang for the buck. Take a look at that here. When we look at a simple table like this, we can sort by ENPV, but we see very quickly that those projects with high ENPVs, well, some of them have very little cost to launch, and some of them have a significant amount of cost to launch. So clearly we need to take that cost to launch into account. And sorting simply by cost to launch isn't going to give us those projects with the highest ENPV. So what we can do instead is look at a frontier. And this frontier will help us see, using one of those productivity metrics we talked about, which projects are most productive and least productive. So our productivity metric here will be ENPV over cost to launch. And we're going to plot this cumulatively with ENPV cumulative on the y-axis and current year cost on the x-axis. So let me turn off the annotation. So what we have here is a frontier that shows us the most productive projects on the left and the least productive projects on the right. And we can begin to ask the question, if we had $100 million, for example, these would be the most productive projects to fund. And these would be, over here, you can see they're actually cumulatively adding less to the total ENPV of the portfolio as you add them. So the curve actually seems to bend down a little bit over time. You can see your most expensive projects here, such as metaphysis and varminase, that when you add them to the plot cumulatively, they're adding quite a bit as you move to the right. And you can see here the same for Refavel. It's adding approximately 105 million to, 40 million to the current year cost. So we're moving 40 million on the x-axis as we cumulatively add that project. Now, the problem is, as we look at the projects that are, say, most productive and we could afford for a straight 100 million in the current year cost, you might be throwing out some critical projects. So let's now take a look at that. So portfolio management isn't about strict prioritization. It's a dance between value and balance. And when you prioritize, you look at value, but you don't look at balance. So we're picking the best set of projects, not just the best individual projects. So the best set of projects will meet multiple portfolio objectives, not just a value criteria. And really what we have to be asking about are what are the portfolio objectives and which set of projects achieve those objectives. So let's think for a moment about what those objectives are. Those objectives are a composite of a target and a bucket. So the target might be a revenue target in a specific therapeutic area, or a revenue growth target in a specific region, or even an R&D spend target in a specific franchise that is a burgeoning franchise that needs more development to become mature. And so when you think about these objectives, it's not enough to say, let's get the highest NPV projects across the entire portfolio. But you begin to need to think about what are the specific balance metrics that represent the right amount of spend in each of our therapeutic areas, the right amount of revenue growth across a series of franchises, and what are the specific trade-offs between short-term and medium-term growth. And for that, we have the ability to look at multiple different dimensions. And so we can see here, we have our frontier that we built before. And let me go ahead and add all the projects to this portfolio. And let's say we have a current year cost constraint of $140 million. What we're going to do is take out enough of the lower priority projects so that we take that current year cost down to $140 million. So we're down to 212, now we're below 200. Now we're almost there. We can add that one back in. So now we're at $140 million, but if you look at our costs for the current cycle, you can see we've taken out all of our phase 1 compounds, and we've pretty much gutted the CNS therapeutic area too. So by removing those projects that are just least productive across the whole portfolio, we have taken our portfolio wildly out of balance. And so really what's necessary here is to begin thinking about across the portfolio for each of these therapeutic areas, what are the highest value programs, and let's think about balancing that with phase. So let's bring the phase in here and start to look at phase and NPV and find the highest projects with respect to their phases, and now begin to more judiciously bring that balance back in. And there are certainly optimization techniques that can be used for this, but when it comes down to the brass tacks of the individual projects in the portfolio, there's no substitute for simply looking at them and being able to make decisions on them on a one-off basis, because that's the way these projects are going to be looked at by the executives. Okay, now we're moving forward to risk management and thinking about portfolio risk metrics. So portfolio risk is a fairly advanced method because it requires Monte Carlo simulation at both the asset and the portfolio level for many of the visualizations I'm going to show you. But it does let you answer the question, how might the entire portfolio fare given the uncertainty that exists for each of the assets and for each of the therapeutic areas, and then the portfolio as a whole? So you can see some metrics that we're going to be reviewing here on the right, from risk-adjusted NPV, expected launches, and then looking at revenue, both in terms of probability bands and then also hitting a specific revenue target. So one key with portfolio risk metrics and your portfolio review in general, get acknowledgement and consensus up front that these are the analyses you're going to do for the portfolio review. Don't spring them on the executives or the therapeutic area heads without enough previewing and enough buy-in that that's a valuable metric. The portfolio review is not the time to show new things off and showboat. So the simplest thing is to just look at the risk-adjusted NPV, either on a project-by-project basis or here for entire therapeutic areas and the portfolio as a whole. And you can see that there's a nice correlation between the NPVs of these therapeutic areas and the risk-adjusted NPVs up until dermatology and ophthalmology, where you actually have a flip. And ophthalmology has a higher NPV, while dermatology has a higher risk-adjusted NPV. Getting more sophisticated, you can begin to look at the NPV or the risk-adjusted NPV at the portfolio as a probability distribution or a histogram of possible outcomes. So you can see this portfolio has a mean around 4.5–5 billion, and there is no probability, as the inputs have provided here, for getting a negative NPV. It's a good thing. And the NPV has a potential upside, albeit a low probability one, of as high as $8.5 billion. So this requires both Monte Carlo simulation at the project level and then saving the results of those as samples and moving those to the portfolio for further aggregation. So the next output we're looking at here is expected launches per year, which is nice because you can begin to ask how many launches on a risk-adjusted basis can we expect in each year. And you can see here this is given on a project-by-project basis. So in 2015, there are 3 products that might launch, but we think on average about 2 of them will launch. And you can do this not just at the project level, but of course you can roll this up easily to, say, the therapeutic area level. And so you can see within each of the therapeutic areas what's our estimated set of launches. Expected versus potential revenue is another metric that often is used in our portfolio reviews with clients. The potential revenue is assuming PTRS or technical and regulatory success for every product and every project that's in the pipeline. And this is contrasted with the expected revenue, which is going to be less if there's any uncertainty in success, because it looks at the actual attrition that will occur. And so it's important to compare your revenue target for a franchise, a TA, or the whole portfolio against both potential and expected revenue. Here you can see we have a revenue target that's being met by our expected revenue up until 2023 when it begins to fall short. So revenue can be looked at in an even more sophisticated vein by using probability bands. So this again requires simulation at the portfolio level to aggregate the revenue of all the assets. And here you see we've created 3 probability bands, although you can create as many as are useful across different confidence intervals. Here you have an 80% confidence interval, 90 minus 10 is 80, and the 90% upper limit is on the top, and the green bar on the or line on the bottom is showing you the lower limit, the 10%. And then you can overlay this with a target. And now you can begin to ask the question, what's the probability of hitting a revenue target? For example, here we can look at in 2020, looks around Q3, Q2, there's a 90% chance of meeting the target. That is, there's a 90% chance of the revenue being higher than that target in that year. However, there's only a 10% chance of the revenue being higher than the revenue target in 2025. Okay, now we're moving forward to portfolio reviews. So we all know portfolio review season is a very trying and very stressful time. You're trying to nail down the project valuations, and those are moving targets, and you're at the same time trying to build a story and scenarios around the entire portfolio. So just how trying is it? With our Enrich Analytics platform, we're able to look statistically at activity in some of our client systems. And we can see here for one client, in a 2-month period leading up to a portfolio review, it was quite busy for the several weeks before that review. It was a 100+ asset portfolio, and there were thousands of logins, multiple thousands of project opens, multiple 10,000s project changes, and multiple thousands of portfolio opens and scenario analyses that were performed. So with all of that happening in the background, it's critical that you think about how to avoid garbage in, garbage out, assess the portfolio in light of the strategy, and retain executive confidence and make sure that the executives, even with all of this velocity of change, have confidence in the process and the numbers that they're looking at and using to make multi-million-dollar decisions. So how do we do this? Well, grace under pressure requires, first, consistent data structures. And when things are changing as fast as we just saw they change, something as simple as not having a simple project naming scheme can derail you and actually force you to delay a review for weeks or months. When spreadsheets are flying around and people are asking which project has made this change or that change, and the names aren't consistent, people will start to guess. And when they guess, they're often going to get it wrong, and then the results of the valuations at the portfolio level won't align with the project teams. The executives will lose confidence in the process. Similarly, consistent value metrics and the way those metrics are created, schedules and milestones, and the cost structures all have to be very uniform across all projects. Even review scope is critical. Which projects are up for review? Is it phase 4 or just things that are in the clinic or just things that are phase 2A and beyond? And what's the available budget that's on the line here? Is the budget 10% plus what it was last year, 10% minus what it was last year, or some other fixed amount that's known from a different set of calculations? I've seen portfolio review meetings spend the first 20 minutes asking, how much money do we have available? And that's something that needs to be prepped beforehand. Being accountable for every piece of information is critical, and it's not the portfolio's job, the portfolio analysts and portfolio team's job to be accountable. The accountability for the project data has to lie with the CEOs of each brand, understanding who can provide the data into the portfolio process and what vetting and validation it's undergone is critical so that there are no embarrassing ahas when the data comes in front of the executives. Establish a lockdown date, unlike that ticker tape that you just saw a moment ago, where changes don't occur up till the moment of the portfolio review. And think about blessing each of the project's details in pre-meetings, and then having multiple portfolio meetings to refine the portfolio investment plan over a series of a week or two, where different scenarios are suggested and then created over a day or so, and then brought back to the executive team. With all of this change occurring, it's important to think about establishing an operations room where everyone can sit, because email and telephones and even web conferencing isn't enough given the velocity of change that's occurring. And then thinking about unified storage. Again, with all of the changes that are occurring so quickly, it's helpful to have an online system for a centralized repository, or barring that, at least a Google spreadsheet or other consolidated means of keeping all the spreadsheets in one place, where you have version control, you can roll back and look at earlier versions, and you understand how those numbers have changed over time and who's made those changes. So let's talk about the portfolio review itself for a few minutes. We're all wired to connect to stories and not to data. And I think, too, a story in 3 acts seems like part of our species' storytelling DNA. So we begin with where we've been, talk about what challenges we've had, where we are, how we've surmounted those recent challenges, and what the current state of affairs is, and then where we're headed. So these 3 acts will get everyone on the same page. They'll help everyone appreciate what's been accomplished and ready them for the challenges and hard decisions ahead. Your portfolio review should contain in some form these 3 components to be effective. So I don't know if any of you remember the 1993 classic film Groundhog Day. So Bill Murray was living the same day over and over and over again, and he tries to break the cycle of endless February 2nds with extreme endeavors, including kidnapping Phil the groundhog that you see here. So I think executives feel like this sometimes in portfolio reviews, where an unsettlingly familiar sort of chaos ensues from the first slide. There are fundamental disconnects that appear in expectations, and executives ask what they feel is a simple question, and it sends the portfolio team into a tailspin. So the key here is to avoid Groundhog Day. And the question is, how do we do that? The first matter is level setting and establishing continuity. Understanding through pre-briefs with each executive, what are the meeting objectives? What's the agenda of the meeting? What are the roles for the meeting? What do the executives need to do, and what constitutes a successful meeting? And then also consensus around the materials that will be used in the meeting. As I said earlier, it's not the time to surprise the executives with shiny new graphs or analyses they haven't seen before. And also, as we discussed, getting buy-in on the individual forecasts and the overall forecasting methodology in advance of the review meeting is going to allow you to stay at the portfolio level in this review meeting and not dive down into the project weeds any more than necessary. Then we want to ask, what did we set out to do? What were the major decisions of the last meeting and review cycle? What were the challenges we faced? And this is the beginning of our 3-act play. what actually happened in the context of these challenges that we had at the end of the last review cycle. Did we succeed or did we fail, or was it more nuanced than that? And what's the currently available budget? And what's the current set of ongoing projects that have been pre-briefed with all the executives? So this now is a perfect lead into the challenge of the day. What needs to be done today and what will constitute success? So with all of this done, you can pick up where you left off at the last review and answer the question where we are. So portfolio reviews are a dance, if you will. You want to stay focused on the strategic view, but of course, the project view sometimes intervenes, and we find executives' most productive mode is actually to start strategic and then dive down very quickly into a specific project, understand that project's nuance or detail, and sometimes it's a confirmatory dive, just to get a sense that that project is exactly as I thought it would be, and that builds confidence in the whole process. But if you can't dive down into that project view immediately, then the confidence is actually going to waver and the whole portfolio process is in jeopardy. Sometimes it gets even more detailed, and executives want to understand about spending, value, project status, and the nitty-gritty. And so the fact is, portfolio analysts like all of you out there probably know this already, and you create these heroic PowerPoint decks that have hundreds of slides in them, and then backups on top of those hundreds of slides in the hope that you'll be able to answer any question the executives have. So that's certainly one way to do it, but another possibility is to have a method where you actually have all the data integrated into one place. And you can look at that data, as we saw a few minutes ago, in an integrated set of information, and you can pull in more information as needed into this set. You can focus on different pieces, look at those projects that are launching later or launching earlier, or break this down, say, by phase, and look at those same characteristics and attributes. But a key here is as soon as you need to drill down because the executives are asking for more information, it's possible to do that and do that very quickly. And you can begin to look at not only critical statistics such as NPV or cost, but also an entire profit and loss statement or information on the product profile or the label. Because this information gives critical context, remember the revenue story we talked about earlier, to the overall valuation for this particular project. So when we look at the product profile and the label, it provides a basis for bolstering whether that NPV and whether this revenue stream seems achievable or seems like a pipe dream. Sometimes what we're looking for is a more graphical and a more strategic view as well. And in those cases, we can look at that view by, say, creating a pipeline chart that looks at each of the therapeutic areas and maybe looks at them by launch date. And now we have a sense of what our pipeline looks like for each of our therapeutic areas. Or we can do this more traditionally and look at the kind of charts that are purely qualitative, looking at when our projects are risky and not risky with respect to launch, and then also looking at NPV and perhaps a risk-adjusted NPV as well. So all of these allow us to go very quickly from that top-level strategic view down to that more specific project-level view. So I wanted to also talk about where we are, that second act in our play, in the context of variance analysis. And so I thought of this album cover, but when I thought about it further, variance analysis is really something that David Bowie knows a lot about. He's had so many personas over the years, so many looks over the years. You can't judge him by just one picture or just one album. You have to understand the whole saga that is David Bowie's career. And he was doing all of this while Madonna was in diapers and Lady Gaga wasn't born yet. So if we think about variance analysis, the simplest thing we can do is simply ask the question, what's changed since the last portfolio review? And so you can see here a simple variance analysis for revenue over time is going to highlight those projects that have had an increase in revenue or a decrease in revenue over the last review period's time. And you can look at this both on a metric over time, like revenue, or you can look at something like ENPV. And then it's important to look across the therapeutic areas and see what the variance has been for each of those therapeutic areas, and then be able to drill down and say, within a given therapeutic area, the project with the most ENPV erosion has that erosion as a function of the fact that a year ago we were looking at a $500 million revenue a year project, and now we're looking at a closer to $250 million a year peak revenue project. So we can begin to understand in the context of each of the projects in our portfolio, where is the variance coming from and what's changed over time. Again, trying to further that conversation. So that's how you drill down and look at the revenue, or excuse me, the variance for any given project. But another tool that a lot of clients use is a waterfall, where we have actually 6 pillars. We have the last portfolio review's metric of merit, and let's make this ENPV. So we have a $6 billion portfolio a year ago, and now it's increased to a $9 billion portfolio. So how did that occur? Well, we had a series of portfolio drops, and these are the projects that have been removed from the portfolio, and that's resulted in an erosion of ENPV. And then we have a series of projects that have had a reduction in ENPV since the last review period. And then happily, in this case, we have a large number of projects that have increased their ENPV. And we can look at this, say, by therapeutic area as well. So we can see, the bulk of these projects that are adding value are in endocrine, but they seem to be pretty well represented across the board, resulting in this overall increase to $9 billion, a $3 billion increase in ENPV since the last review period. So without this variance analysis capability, which you can certainly do in Excel as well, you're going to leave the executives behind because they are probably already anchored on where things were at the last portfolio review, and this needs to bring it home to the current portfolio review. So the final act is where are we headed? I put this image up because the best way to invite change is to make the present course completely unpalatable, because change in itself is difficult. So to ask the question, what will the portfolio get us, and will we meet our targets, and how likely is it, based on how we're spending our funds today and investing in our R&D pipeline? So scenario analysis becomes a perfect way to suggest the value or the liability of the present course, and then to present alternative courses. So for scenario analysis, we can look at the analysis that we were doing previously, where we move projects in and out of the portfolio, and we see how the revenue changes and whether we meet our target and whether we're balanced across some critical dimensions. But we can take this one step further and do a scenario comparison where, and I'll scrunch up these charts so you can see, we have the ability here to move projects in and out of these 4 portfolio scenarios here. And you can see quite clearly the bubbles here represent not just projects, but actual portfolios. And so each of these portfolios represents a different set of projects we funded, and we can see which of these are able to meet our revenue target, which is the blue area behind here, and which of these are coming in under our budget. And really, with the exception of the all-in portfolio, they're all meeting our budget constraint from 2016 or 2015 onwards, and they're meeting our revenue, all of them are meeting our revenue targets. So the question here might be, are we being aggressive enough with respect to our funding, and are there other projects or initiatives or partnerships that we could undertake and move the value of this portfolio even higher than our revenue targets? So to recap, the purpose of all valuation has 3 components to it: project attractiveness, the common understanding and comparability and then enabling those effective conversations both at the project and the portfolio level. I hope you've gleaned a few pearls of wisdom you can take back to your portfolio team, or at least that you feel a little less alone with the challenges of your organization, because there are common themes across all the companies we've spoken to and work with who do portfolio management. And portfolio management is about manifesting change, so you're trying to create more value for your firm. And being an effective agent of change, well, it's easier said than done. So our team at Enrich is passionate about portfolio, and I know many of you are as well. Good luck to you all, and thanks for your time today. And I'd love to hear your comments and feedback both in the remaining time and later. Don't hesitate to reach out. Thank you so much.
Thank you so much. We've had a pretty steady stream of questions, so let's get started with those. How do you treat the cost-only projects? For example, safety-related projects that don't bring any incremental revenue?
That's a good question. Many times those are not discretionary, and they are required from a contractual standpoint or a regulatory standpoint, and those belong in the base cost of the portfolio, or at least bundled with the projects that they are enabling. So if that is a base cost associated with a technology platform or a franchise, it gets bundled with the cost of that franchise. Even if there's only one additional molecule in that franchise, it means that that cost gets triggered. So it's important not to leave those behind. And another corollary to that is thinking about the broader set of things that your company spends money on. In the most successful portfolio processes, they're actually trading off not just R&D project against R&D project, but R&D project against IT initiative, and R&D project against human resources initiative, and the next building that they want to build for office space, because your investments are across the board competing for the same resources when you use the proper scope. And it may be that you need to take that broader view to see where the company's truly spending money that could better be used in research and development.
Okay, we've had a couple questions come in regarding how often a portfolio review should be conducted.
That's a great question as well, and it depends on, of course, the culture of the company and the appetite for change. And if the velocity of change within each of the product groups or therapeutic areas is very fast or very slow. So in many cases, we have incremental reviews at our clients on a quarterly basis, or there is a half-year portfolio review, and then 6 months later, there is a strategic planning review, which looks at it with a slightly different lens, a longer-term lens. So oftentimes we'll see companies begin their journey with just an annual review, and they'll begin to see as their data matures and their process matures that they have all of the pieces in place to get value out of a review maybe every 6 months instead of every 12. And then in some cases, they'll move to an evergreen process where they're able to look at a new in-licensing opportunity, or if there's a stop the presses event in a clinical readout that occurs from a critical phase 3 compound, that means that money and resources are now being freed up for other projects. Emergency can be held, emergency review meeting can be held, and at any time when this information comes to light, they can revisit the portfolio and see what is, what would I say, most willing or most able to use these additional funds that have been released. So it does start at a yearly basis, and it can get more frequent depending on how mature your process is.
All right. Another attendee asks, is it relevant to use portfolio management tools and processes for a 5 assets portfolio?
That's a great question. And the answer hinges upon how many different scenarios you're thinking about for each of these assets. So if there are 6 different development pathways for each of those assets, you don't have just 5 assets that you're thinking about a go, no-go decision on, but each of these assets has multiple development possibilities or go-to-market possibilities or partnering possibilities, you can start to have fairly complex portfolio landscapes with just a handful of assets. Another possibility is if you have no portfolio problems in the clinic, but you have portfolio problems in your discovery phase, and you're thinking about many, many different possibilities there, you may constrain your portfolio management to your early stage assets and discovery.
Okay, there are so many questions. I'm having trouble choosing one here in the time remaining, but let's try this one. This attendee has considered an Enrich system before. They talked about it, but they'd like to know, in your experience, what's the minimum number of projects you should have in a portfolio for the system to be a worthwhile investment?
Boy, I hate to just keep saying it depends. I think that if you have 5 projects with 5 scenarios each, that's worthwhile. If you have 30 projects with no scenarios, or maybe even a few buy up and buy down scenarios, that's certainly worthwhile. Another situation that's worthwhile is if your portfolio process is highly distributed. You have folks in commercial providing your market data, folks in clinical providing your cost and schedule milestone data, folks in clinical or elsewhere providing your risk data, and you simply need a repository so that there's more confidence in the valuations and you're not throwing spreadsheets back and forth at the speed of light, then even a smaller portfolio can warrant use of a tool like ours where things are centralized and you have much more confidence in the valuations that are being performed.
Okay, and we've got just a minute or two left. A short question. How do you handle timeline risk?
So it's funny that someone should bring that up. When we started this in 2000, 2001, building these tools, we actually had each client enter the uncertainty in launch date as a function of the uncertainty in each of the components leading up to launch. And we saw very quickly that most companies weren't ready for that level of uncertainty analysis. But that is the way that you can undertake this, where you either simply provide a range where you think launch will occur, or you break that down and provide a range for each of the constituent components, either at the phase level or at the study level below phases. But each of those successive levels of complexity is a burden on the development team, and it's more data to have to look at when, as an executive, you're interested in transparency and clarity. So there's a trade-off there, but you can get a lot of insight, especially if you just have a few things in the clinic, by taking into account those delays, which we all know occur. One client we were working with did a postmortem and found that over 60% of their studies and study activities were at least 6 weeks late. So with that kind of delay being so common in the industry, it's important to characterize that if you have the political will and the stamina to do so.
Excellent. And I see we've come right up on the hour. We do have many more questions. I will forward those along to you, Dr. Sonnenblick, so that you can answer them directly. I'd like to thank you, Dr. Sonnenblick, for your wonderful presentation. I'd like to thank our sponsor, Enrich Consulting. And most of all, I'd like to thank those of you who came and spent some time with us. I hope you found the answers to your dilemmas. I look forward to seeing you at future CHI Global Web Symposia. Thank you, and have a wonderful day.